The first exercise that we will do is exercise 7-6. This exercise will demonstrate the allowance method percent of sales. It is the income statement approach. We analyze our credit sales and determine a percentage based on historical facts, most likely, of those credit sales that we deem uncollectible, will be uncollectible by the end of the year. So let's go ahead and get started. At the year end, Chen Company estimated its bad debts at 1% of its annual credit sales of $487,500. They record that as their estimate. So let's take a look at what are we going to do here. So we know that we're going to make an entry on December 31st, their year end, and we are going to call this bad debt expense. And just so that you remember how we came back at it, if you need to take a look at it, this one is 487,500 times 1%. So let's just go times 0.01. We don't subtract anything. Remember, the income statement approach, we simply take the credit sales times the percentage that we believe will not be collected. So over here in our debit, I'm going to say 487,500 times 0.01. We have not tied this amount to any specific account like we did in the direct write-off method. This is our estimate of all of our accounts, what might not be collected. So we're going to call this, we're going to use that new contra account. And the name of that account again was called the Allowance for Doubtful Accounts. That credit amount will be the same, $48.75. Then on February 1st, they decided that they did identify an account, P Park, as uncollectible, and they wrote it off as a bad debt. So on February 1, we're going to take a look at our accounts up here. We've got $580 that we are writing off. So we are going to now debit that allowance for doubtful accounts. And the amount that we will debit that for is $580. Now this doesn't affect our income statement anymore at all. The income statement was impacted by our entry on December 31st. That's where we're matching the revenues and the expenses. We're estimating of the sales that we had for that year, the prior year, $4,875 will not be collected. Now it's February of the next year, and we are realizing $580 that is not collected. So we take it out of our allowance account, kind of reducing our estimate, and we credit our accounts receivable, P Park, and that amount will be for $580. Let's go ahead and indent this because that just makes me crazy when they're not like that. All right, on June 5th, what happens? Park unexpectedly pays the amount that was previously written off. So just like the direct write-off method, we're going to put it back in Park's receivable account because we kind of want to track what happened there. And so we'll debit that for $580. Now, instead of a credit to the bad debt expense like we did in the direct write-off method, we're going to put it against the allowance account. So we took it out of there because we thought we used some of it up. Turns out we didn't, and we're going to put it back. Now we've restored that allowance account back to the $4,875. And don't forget when you do this that you have to remember we actually did receive some cash. So let's put that in, $580. And we have to take that now out of the accounts receivable for P Park. I'm just going to make sure, can't remember if we had anything below that. All right. That's the percent of sales method. The income statement approach, the easier of the two income statement or balance sheet approach of the allowance methods. Now let's take a look at exercise 7.7. Here we are going to look at the balance sheet approach. Let's see, we didn't get over to 7.7, there we go. This will be the balance sheet approach. We have, oh gosh, what did I do? Somehow I've got the amounts from 7.7 coming over. Let's pause for 1 second and I will get this fixed up. All right, here we go. This is the accounts receivable method. We're going to look at our accounts receivable overall balance based on historic numbers. We're going to take a percentage and determine that that will be the amount that is not collectible. So in the beginning, we've got Maisie Supply Company, and they have an outstanding accounts receivable balance. So we're just going to come in here and say that our balance is $55,000. And do we have a balance in our allowance account? Prepare the year, assuming the allowance account has a $415 balance before adjustment. So I'm just going to label both of those beginning balance or before adjustment, however you want to call those. And on 12/31, we are making our entry. Again, we are debiting bad debt expense. So in the allowance method, the only time that you debit bad debt expense is when you are adjusting the allowance amount, whether it's the percent of sales method or the accounts receivable method. In this case, our bad debt expense is going to be the $55,000, the receivable balance, times the percentage that we deem will not be collected, which is 2%. So let's say times 0.02, and that's our debit, times 0.02. Our credit will be to the allowance account. Oh, wait a minute, what did I do wrong there? Ah, yeah, this is the balance sheet approach, right? What do I have to do? I have to look at what is already in that account. So this isn't necessarily going to ring true, is it? No. So my estimate of uncollectibles, if you want to do that like this, estimate of uncollectibles will be 55,000 times 0.02. So I know that this number needs to be the ending balance of my allowance account. That's what I need to wind up with right there. So how do I get from 1,100 when I currently have 415? Well, I need to adjust the difference, right? So let's just do this. Just say we know this needs to be that, right? 1,100. So my adjustment will be the 1,100 minus the 415. So I'm going to adjust, not the 1,100. I'm going to adjust the difference because I'm working with the balance sheet account, and balance sheet accounts have balances that carry over from year to year. So my amount is $685, and I'm going to credit the allowance for doubtful accounts. For the same amount. So we could have just come down here and said, yeah, this is what we know our balance to be, and taken the 55,000 times 0.2, but I just wanted you to see how we worked into that. All right, let's go to exercise 7-8. So we did the percentage of sales method, income statement approach. We did the percentage of accounts receivable method, balance sheet approach. The next balance sheet approach that we will do is the aging of receivables method. Works the same way as the other one, but we're going to arrive at our number a little bit differently. Remember, in this one, we take a look at our aging, and we estimate based on those ages what amount of those balances will not be collected. So again, I'm going to pause. I don't know why this is coming through like this. Hold on. So let's get some of our information that we need. Our total accounts receivable is beginning balance 570,000. And does it give us our, where does it give us our beginning amount for the allowance account? So if we go back to the problem, it tells us that the beginning balance in the allowance account, this is under item B, is a credit for 3,600. So we need to know that, right? Because that factors in our entry. All right, so now to do our estimate of uncollectibles, we're going to say, we're just going to multiply these out. 396,000 times 0.01, 90,000 times 0.02, 36,000 times 0.05, 18,000 times 0.07, and 30,000 times 0.1. And then we sum all of those. All right, let's get some formatting better here. And we come up with an estimate of $11,820. So is this the amount that I should record? It is not, right? I know that this is what my estimate needs to be. This is what my estimate currently is. So I'm going to grab this number. If I'm at 3,600 and I need it to be 11,820, I'm going to take that number minus the 3,600 to get a debit to bad debt expense required of $8,220 and a credit to the allowance account. So again, I believe we're at 1231, and we'll say bad debt expense 11,820. Oops, 8220, our adjustment amount right there, and our allowance for doubtful accounts will be a credit for 8220. Okay, that's the end of our exercises, but I just do really want to talk through on these allowance accounts. Remember, what would have happened if we set our beginning balance over here was 500. Now what do I do? Now what's my adjustment? Okay, so my balance is, so if we do this, right? Let's take this out for the moment. And let's bring in a line here. Okay, so I would have a balance of 500 and nothing there, and I need to get to 11,820, right? So I know that that should be a credit balance. So right now, what do I need to do to get that to balance out? What do I need this number to be for this to be 11,820? Well, this number minus this number equals 11,820, right? So I'm going to add those two. Now this is only when it is a debit balance, remember. I should probably, for illustration, do it this way. So now we've got the 12,320, and I can see that 12,320 minus the 500 equals my required balance of 11,820. So then down here, that would now be my number. Okay. Hopefully this all made some sense to you, and let me know if you have any problems.